Hi, good morning, everyone. Welcome to Sygnus Real Estate Finance Limited's earnings call for the year ended August 31, 2023. My name is Justine Powell. I'm a part of the investment management team, and I will be a moderator for today's call. We do appreciate you taking the time to join us to learn more about the recent financial performance for Sygnus Real Estate Finance Limited, or SRF. Now, during the call today, the management team will discuss the financial results for the year ended August 2023. We will provide some updates on the business operations and also outline the plans for the future. Now, following the discussions and the remarks that we've prepared, we will actually open up the call for questions from our investors, researchers, and analysts. Before we begin, I do want to remind everyone that the discussions today will include forward-looking statements, and these are subject to various risks and uncertainties that could cause our actual results to differ materially from our expectations. And as a result of that, we do encourage you to review our audited financial statements as well as the management discussion and analysis that has been published on the Jamaica Stock Exchange website as well as our website. I want to now take the time to introduce our presenters for today. So we'll have two main presenters. We will have our Executive Vice President and Chief Investment Officer, Jason Morris, and we will also have our Vice President and Head of Real Estate and Project Finance, David Cummings. And I'll now hand over the call to Jason.
Thanks, Justine. Good morning, everyone. Hope everyone is enjoying the little rains. I know that everyone might have been a bit shook by the recent earthquake. So I trust that everyone came out of that without any serious damage to either person or property. So, keeping standard practice, welcome to the earnings call. I'll provide some highlights, and David, who is head of real estate, will also be providing an update on the individual assets. Now, to start out, I just want to create some backdrop. So SRF, once again, during the financial year, would have continued its quest to continue enhancing shareholder value. And during the period, I'm happy to report that we would have completed the first of the projects that we would have embarked on. Way back when we made our one of our very first set of investments, which is the build-to-suit Spanish Penwood industrial facility. So that was completed, and of course there are minor items still to brush up on, but we would have completed that, and subsequent to the end of the financial year, would have exited the majority of our position to institutional investors. So it's a great period for SRF where we can say yes, one of the transactions that we started, we conceptualized, we executed, and we have done and dusted that one. Second thing I want to highlight is One Belmont, and of course David will provide a lot more information on the individual assets as highlighted earlier. But we are now at 90% completion with expectation that we'll get this done prior to the end of the financial year. Of course, we expect occupation of the building next year. And we have also started structuring of SRF's investment exit. Perhaps one thing that I should have mentioned regarding Spanish Penwood was that the tenant would have paid, I think, 4 months worth of lease payments to date. So, the exit and the exit is well and good. Third thing I want to highlight is that book value per share would have gone up to $23.89, coming from $23.24 in the previous financial year. So we continue to push very hard to enhance shareholder value. And finally, we would have, as we would have stated, that we were nearing the end of our first investment cycle. And so during the financial year, we would have exited 594.3 million in exits, primarily from real estate investment notes, which are third-party investment projects. So we can move to the next slide, Justine. In terms of financial performance, again, the backdrop to this is, SRF is investing, deploying capital, lots of capital deployed up front, and then as we get to the end of the investment life cycle, there's naturally going to be a slowdown in the deployment of capital, and then an increase in exits. And in many instances, what will happen is that some of the returns will be generated up front, and then we get the cash flow at the back end. So this is what is being reflected in the financial statements, where you will see in terms of total investment income, we made 765.56 million relative to 1.35 billion in the previous financial year. Of course, in the previous financial year, we would have had much larger gains on investment property because of the natural nature of when we would have acquired investment property and the gains on those, as well as gains on our share of profit on joint ventures, which would have been substantial last year when one Belmont would have gotten past the halfway point of execution. With regards to net investment income, that was 212.58 million relative to 983.6 million in the prior year. And of course, what I just explained with total investment income, along with operating expenses, would have resulted in the current outcome. And the combination of the level of net investment income is what would have driven the level of net profit, which total 11.44 million, down from the 692.95 million in the previous financial year. So we are in a cycle whereby as the first investment cycle ends and we are about to begin the second investment cycle, we naturally tend to see this plateauing or this troughing, and then once we begin to deploy aggressively from the exits that we have, then we expect to see the profitability of the firm reaccelerate, and this will naturally happen from cycle to cycle, just based on the nature of real estate investing, where you deploy capital and invest up front, and then at the back end you receive the cash flows. So book value per share, as I mentioned before, would have increased to 23.89 versus 23.24 per year. And that translated to a basic earnings per share of 0.65. That makes sense related to 2020 cents in the previous financial year. All told, for the financial year, the return on equity would be about 2.5% thereabouts on the financial year, but over the 4 years since SRF would have started operations, the overall average return on equity is 22.9%, which is the key metric to watch in terms of from the day that shareholders gave us their capital, what have we done with it in terms of looking to generate returns. Obviously, the performance metrics aren't going to be evenly spread out, and as we would have mentioned in a couple of quarterly earnings calls, if you recall, when SRF would have been reporting kind of negative earnings, we would have stated that, come the end of the financial year, which is when the majority of the return metrics based on SRF's business model gets captured into the financial statements, we would expect that those negative quarterly earnings would have been reverted back to positive, which is what has happened. Now I want to provide some additional insight on the actual income statement itself. Looking at net interest income, you see that it's negative, and that was negative primarily driven by a much higher interest expense, and that was due to a combination of things. Obviously, as the balance sheet would have increased, we would have funded that using debt, and the cost of debt would have been higher than the previous financial year, but also would have utilized more debt during the course of the financial year. You cannot really see that by looking at the balance sheet per se, because we would have also paid down debt from investment exits that we had, right? So I'm just saying that we would have utilized more debt, which would have increased interest expense substantially. Of course, interest income would have also gone up, but SRF isn't primarily in the business of generating interest income per se, although we do have interest income being generated from our real estate investment notes. And so we have negative net interest income, which we expect to reverse as we go forward, because what also would have impacted on the top side of the interest income is that we would have exited, as you would have seen, almost $600 million worth of real estate investment notes or REINs, and those are actually our interest-bearing investments on the asset side. So as you exit that, and the timing of exiting that and then redeploying, of course, to redeploy into REINs, basically using a drawdown schedule almost all the time. And so it takes time to then redeploy that capital. So you're going to have timing mismatches where you exit income generating real estate investment note, then you need to redeploy the capital over, say, 12 or 18 months, depending on how long or the timing of the deployment of those capital. And so we expect that to ramp up over time. In terms of lease and other income, lease income would have increased substantially relative to the previous year. And one of the contributing factors to this is that we would have generated, I guess, a portion of lease income from the completed industrial facility, which I was mentioned in the opening slide. Obviously, on a go-forward basis, given that we have subsequent to the end of financial year, we would have exited the investment, that lease revenue won't be recurring. However, on a go-forward basis, what is likely to occur is, as you would have seen in the opening slide, where we said that we have started the process to partially, for SRF to partially exit the One Belmont. Then, whenever we do that partial exit, that means that SRF will more than likely be holding a part of One Belmont in some way, shape, or form, and therefore, some of those income could be reflected on the income statement on a go-forward basis. Gain on investment property, 430 million, and share of gain on joint ventures, 340 million. I would have mentioned this before. These gains were lower than the gains that we had in the previous years, and that's just based on the whole nature of, I guess, the volume of real estate asset that we have and when we acquired investment property, as well as where we are in the life cycle of primarily the One Belmont development. So as we go through time, we're going to have cycling down, then rebuilding of the book on the asset side, and then redeploying, and then we go again. Also wanted to highlight the net FX loss, which is actually an unrealized loss. And this is really related to the fact that we have foreign US dollar liabilities that are backing some of the real estate assets. But bear in mind that even though pretty much all of the real estate assets are actually US dollar investments, there is no FX treatment of that on a quarterly basis in tandem with the liability. So there's a mismatch there. So what normally happens at the end of the financial year, when there's a revaluation of the real estate asset, the FX movement, is bundled up in the actual, change in the value of the asset. So the FX gain that loss that we see reported in our financial statements is really in relation to the liabilities that we are carrying, and it's unrealized. So I just wanted to highlight those couple of points in case, as usual, people may have questions on those. Next. So in terms of how we're managing the firm, the management expense ratio was well within the 3.5% threshold, and we have done so now for the last 2 financial years. Obviously, 2021, the company would just have pretty much started, and so that's why we were out of threshold there. In terms of the efficiency ratio, we came in at well above the threshold, and that's primarily at 59.2% relative to the 45% threshold. We expect this ratio to be reduced over time and get back within the threshold. Obviously, the main reason why we would have gone outside the threshold limit is just the cycle. We are at the pretty much the trough of the cycle, and we're overlapping in terms of ending one investment cycle and moving into another. And as I mentioned before, during that period, you're going to have a general slowdown in activity, and therefore the transitioning of generation of income. But as we go through time, we expect that this will really be reversed back to where it was in terms of within the 45% threshold. In terms of investment activity for the financial year, real estate investment assets would have increased to 14.92 billion, relative to 13.14 billion last year. Total investment property would make up the majority of this, 10.44 billion versus 9.43 billion last year. Real estate investment notes would have declined to 1.83 billion versus 2.48 billion. Obviously, as I mentioned before, we would have exited from a number of real estate investment note positions, and that's the reason why the value has gone down. And as we continue to exit over the short run, you should see this value trending even lower before it starts to ramp back up as we redeploy capital into new real estate investment notes. Joint ventures, carrying value of that increased to 1.54 billion versus 1.2. Again, this increase will primarily reflect the increase in the carrying value of One Belmont development, because as we move towards completion, obviously the value of the asset is rising. And in terms of exits, I mentioned this before, 594.28 million versus 352.84 last year. And what I can say is that we would expect in the 2024 financial year to have much more substantial level of exits, given the size of the assets that would have been completed and are being exited during the course of this financial year. In terms of dry powder, we had 71 million on the balance sheet, but obviously off the balance sheet we had undrawn construction loans of 319.9 million and undrawn credit lines of 301.41 million. Investment allocation, this hasn't really changed much throughout time because of, we are well diversified across industrial, residential, commercial types assets, and among the different subcategories of those types of assets. And majority of the assets on the balance sheet represent investment property, where we need to unlock that value for shareholders over time. So now, we come to the section where after this slide, I'm going to invite David to give us some update on what's happening with each of the major projects. But this is just a general summary of the major key strategic assets that are on SR's balance sheet. We go through this every quarter. Nothing has really changed here. Everything remained pretty much as it was at the end of last quarter. But what it does, it gives you a bird's eye view of the different type of assets that we have. As you can see, we're broadly diversified across multiple industry types of properties. So now I'll invite David to give an update, a more in-depth update on what's going on with the various projects on the ground.
Thanks, Jason, and good morning, everyone. The first one you see on your screen is Spanish Penwood, which you would have heard Jason indicated is at 100% completion, and we are well advanced in the process of the exit. And now that we're at the end, it's good to pause to just remind everyone what we have accomplished with this particular project here. Clearly, we commenced with a client who approached us and wanted a new location, where what we did at SRF is that we identified the property, we acquired the property, we assembled the full professional team, completed the designs, got all of the approvals, procured the contractor, and executed, and have now handed over the facility. So it's almost a cradle to grave approach, showing the breadth of capabilities that are embedded within SRF to deliver to the client a brand new industrial facility, 32,000 square feet. You know, a very good location, the intersection of Penwood Road and Spanish Town Road, with Chesterfield Avenue across the road just at the stoplight. And anybody who may have driven past in recent times would have had a chance to take a look at the facility, at what will, as they're moving in now, the new home for Imco Jamaica, the local dealers for Caterpillar. But the critical thing here being SRF delivering on a total package for a client in terms of the conceptualization to keys being handed over. Next slide, please, is the Belmont. 9% completion. Again, for those of you who may have driven past on Belmont Road or in this vicinity, it's a fairly prominent site on the Kingston skyline now. The expectation is that we will commence handing over the various floors to the tenants very shortly. What's important to realize about this particular product here, since I know parking is a lot of a hot topic in terms of going around Kingston these days, is that this project here essentially is a 5-story office building that sits on top of a 4-story parking garage. So clearly those persons who work in this building or those who have reason to visit it will, of course, find that we have been very specific about ensuring that we have provided enough adequate parking, since it is a bugbear a lot of places that we try to do business with these days. 1 to 3 Belmont Road, right at the bottom there, opposite JN, sandwiched also by Hart. And as you can see, we are expecting the tenants to start doing their interior build-up works, and we expect full occupancy during the calendar year 2024. Next slide, please. Miami Bay. We have a dedicated team that continues to work on the plans to unlock the value here. We have some very advanced options that we are in the process of presenting to our various internal real estate investment committees. Not made a decision as yet on this one here. Clearly, there's a lot of dynamic factors that we have to take into account outside of just the typical real estate or construction factors. Clearly, there's a hospitality factor here that we have to take into account. But we are inching closer to the point at which we will be able to make a presentation and, of course, reveal the way forward for this particular investment property here. Next slide, please, is Lakespen. The Lakespen asset, this one here is even more advanced than Miami Bay. We are at a stage now where we are beginning to enter the execution phase. More on what we'll be executing here will be revealed in due course, but we have made the internal presentations to our investment committees, and you can expect to see more on the execution side of this project here in terms of unlocking the value as we get into 2024. But rest assured, this is a project based on our research and data from an industrial standpoint, and given the strategic location of this particular asset here, astride the East-West Highway, opposite Wysinco, in the Lakespen area, close proximity to the Port of Kingston, it continues to be an important asset in the actual asset base of SRF. Next one, please, is the Hillcrest, which was the former French embassy, a very lucrative 3.2 acre site. Again, we have a dedicated team that are evaluating. We're down to, I think, 3 options now in terms of how we will likely unlock the value here. It's important to understand what's going on on the overall commercial landscape in Kingston at the moment, and that has to be taken into account in all of these investment decisions. But of course, foremost on our mind is how can we unlock the optimal value for shareholders and investors, and that continues to drive the direction in which we will ultimately go with all of these investment properties here. 56, 58. Likewise, we have on the table three very good options, and we expect that we will make a decision very, very shortly on which option we will take. And again, you know, this is 1.2 acres along Lady Musgrave Road, lucrative location, but the final decision of the option that we will use to unlock value here will be one which will be in the best interest of investors and shareholders. Next one, please. Seaview. Likewise, this one is at the intersection of 3 roads. It's Seaview Avenue on the right. You see Montrose on the left, and out of the picture is Lady Musgrave Road. So a very, very good location from an entry and exit standpoint. You are on 3 very good connecting roads in and around the Kingston 6 area. We have been continuing to evaluate here. Understand that when you do evaluations of these property in terms of investment, there's a lot of things to consider, not just the value of the land. You have to consider planning considerations as to what you'll be allowed to build there. You have to consider cost of construction. There's a number of things, interest rates, that go into the formula that we have to use to understand what is the best way to unlock value for these. So although you may be wondering at times why this takes, but you know, just understand that we have to take the time to ensure that we are doing the best to unlock the value. Likewise, with 16 Montrose you see on screen now, we have an option that we're evaluating at the moment, and we expect that in short order we should be able to reveal whether or not this option here will deliver the sort of results that we're seeking on 16 Montrose. Next one. And from here I go into the range, and when just important just to remind you, I know Jason has explained it, the real estate investment notes, which is what the range is the acronym for, is projects where we are pretty much the financer. So we are providing debt financing to other developers who obviously the ones who are in control of those projects. As you can see, Surreal, we are in the process of the exit. At the moment, the sales of the last remaining units are ongoing, and our realtors are confident that before long we will be able to complete the exit of the Surreal project in Montego Bay. We're well past the point at which we were hoping to be at this stage. So we expect that before long we will complete the exit with the last sales of the remaining units at Surreal. Next one is Norfolk Wausau. We completed our exit of Norfolk Wausau project in August, actually, through a separate financial arrangement. So we've exited and fully, so the Norfolk Wausau project pretty much is at the end for SRF. The next one is Ocean's Edge. This one here, admittedly, has been in the public domain. There were some challenges that the developer encountered here, but we have been working with the developer and the real estate board to resolve it, and we expect that resolution to be in short order. So the purchasers who have been patient, we expect that this matter will be resolved in short order in terms of the way forward here. Next one is where I say thank you and hand back to Jason.
Yeah, thank you, David. So just to provide an update on what we're doing with regard to strategy. There are just 3 legs to this stool. The first one obviously is just execute. Clearly, we have completed Spanish Penwood. 1 Belmont is pretty much close to being done. So that's good progress that we have made there, and these are actually our first two projects that we conceptualized, and developed and executed and exiting, right? Mami Bay, Lake Spin, those are, two other major assets on the balance sheet, and we're looking to extract the value from those, and David would have gone through this already. We also are committed to obviously deploying capital into third-party projects, which is primarily in the form of real estate investment notes. And I would have mentioned before that we're going to ramp that up, given that we are exiting means now, because we need income on the balance sheet in order to ensure that we are offsetting that interest expense. So over the next 12, 18 months thereabout, we will be ramping that up once as we advance exits at the same time. And of course, we are still committed to investing outside of Jamaica. But as I've said on every single earnings call, we took a considered view that Jamaica was the best place in the Caribbean to deploy capital in real estate, based on quite a broad number of factors, including the very favorable tax environment. So that is paying off in terms of the Jamaican environment, where Jamaica obviously has been upgraded, and we expect that it should be upgraded again maybe in another 18, 24 months. And also over the medium term, we expect that the cost of capital in Jamaica, although they are high now, the cost of capital is gonna come back down, right? Because the risk premium that is being charged on Jamaica is gonna be reduced by the fact that our credit rating is improved. And so over the medium term, we feel that the real estate asset class has substantial upside, even though we may right now today be in an environment where, inflation, although it has come down back within the central bank's band, I mean, that's just one data point, but has trended down from double-digit levels, and interest rates are effectively in double digits if you speak about market rates. But I expect that 18 months from now, 24 months from now, rates are going to be lower. And in that kind of environment, I expect real estate assets to thrive. And so it's just for us to continue putting the hard work now and lay the groundwork, so that when that environment comes, we have products on the market, investment that we're exiting in a very bountiful market. Second part of the so to complete the point, obviously we're looking at opportunities in the Caribbean, outside of Jamaica, but for the time being, we want to ensure that we execute on the assets that we have on our balance sheet first. Second leg of the stool, which is dry powder, we have mentioned how much we have on and off the balance sheet. So this is just a recurring decimal. Obviously, once we move into the second phase, where we're looking at, for example, the Mami Bay and Lake Spin, etc., we obviously will finance these investments with a combination of perhaps equity at the individual company level, by inviting investors in at those individual company levels, and debt based on where debt is at the time and the cost of debt, etc., which is what we have been doing and what we'll continue to do. And of course, we'll continue to harvest, our real estate investment notes by exiting them, and of course, the projects that we have completing, which the major one at the moment is really One Belmont, which is is a massive project. We are very, very happy as to where it is, and hopefully by another couple of months, we'll have the ribbon cutting, and all of you guys we can have an actually face-to-face meeting up there. Final thing is, we continue to deliberate over when is the best time to actually what's the best timing to begin the first distribution. So the conversation we are still having, and whenever we think that time is right, we'll come to shareholders and make that. But so far, we continue to work very hard to deploy the capital diligently, try to extract the best value based on how we read the tea leaves in the marketplace, and then just try to increase shareholder value at every turn. And we are very pleased with where we are at the moment with, as I said before, and it can't be overstated, with the two big projects which are our projects, which is Spanish Penwood and One Belmont. And the structure for One Belmont is going to be a very unique exit strategy, where in one instance we may invite by the ordinary person on the street to actually be able to participate in the revenue generating capacity of One Belmont. But that's something that we're working on and structuring, so you can look out for that in 2024, and that will likely be towards the middle to the back end of the financial year for that One Belmont opportunity. So that's something I just want all of you to give some thought to, and we'll communicate more on this as we get closer to that time. So thank you very much. I guess we'll open now for questions.
Thank you, Jason and David, for providing those insights into SRF's performance. As Jason would have mentioned, we're now going to go into the question and answer segment. We have quite a few questions, and some of them I think would have been addressed during the presentation. So I will start off with those that were not addressed at all. And then if there is time, we will touch back on some the other questions. So the first question is in relation to Spanish Penwood. And it says, when does SRF expect to collect the 1.13 billion from the Spanish Penwood sale?
So, good question. So if you recall, on previous earnings call, I would have stated that we structured Spanish Penwood transaction in a unique way, where we would have received half of the money from the institutional investors some time ago, and so what remains for us to collect would be the remaining half. And as would have been shown on one of the slides, in total, we would have received 83% of the sale price for Spanish Penwood, or the exit value. And so we have one investor who is dotting some I's and crossing some T's before they transfer that cash. So we expect to receive that within maybe maximum a couple of weeks. So by and large, we are almost completely receive all the cash. We have 17% left to be precise of the exit value.
Thanks, Jason. So the next question is actually in relation to the Hillcrest property, former French embassy. Has the business faced any hurdles by the associations or the restrictive covenants in developing or determining the intended use for this particular asset?
So I'll take that one. Very good question, and it allows me to point out that one of the things we always do in our approach to developments is liaison with all of the stakeholders. In this instance, the Golden Triangle Citizens Association, NEPA, Parish Council, etc. And even prior to us making this particular purchase, we had already received and reviewed not just what NEPA would allow us to build in this location in terms of development and enhancing value, but we also know what the Golden Triangle Citizens Association would be comfortable with. We also knew from the covenants that we inherited from the former French embassy what restrictions they were in terms of height, setbacks, and so on. So all of the constraints to develop this property were known to us prior to us making the purchase and have been taken into account in terms of the potential development plans that we've been working on. So there have been no surprises to us in terms of any restrictions or constraints as to what we can do on this 3.2 acre property.
Thanks, David. All right, so the next question, I think this one will be both a response to include a clarification on what is being asked. It's in relation to One Belmont assets. You previously reported that the One Belmont was almost fully sold. Now we're discussing a partial exit, so we will clarify that shortly. How partial is partial, and how much of the building do we intend to hold?
So let me jump on that. So first thing is that we didn't say that One Belmont was sold. We never mentioned anything about selling One Belmont on any call. What we spoke about was occupation, right? Do we have tenants for the floors? That's what we spoke about. So in terms of thinking about how you optimize value for shareholders, the way we think about this is we don't necessarily want to quote unquote exit or sell out of One Belmont. Why? Well, because it's a crown jewel in the corporate office landscape in Jamaica, which means that, and if we, based on the tenants that we know we have in there, which obviously you know, the general public does not know, then it makes sense for us to keep a portion of One Belmont for SRF and earn the income on this for a number of periods, for a period of time. And then you can sell the asset, right? Because if you sell the asset later in the life, after it has started to earn some income, it will become way more valuable. And not only that, we are in a very high interest rate environment now. And so presumably if I were to try to sell an asset that has blue chip tenants in it today, and where rates are, and I have that same asset, and interest rates are, say, even 200 basis points or 2 percentage points lower than where they are today, I would presume that the value of One Belmont would be, you know, I don't want to use the word substantial, but it would be higher, and you could get a higher valuation, a higher value. People would be more willing to buy it at a lower cap rate, so to speak, than me trying to sell it now during a high interest rate environment. So it makes perfect sense, and it's perfectly aligned with shareholder value to actually exit a portion of it, because obviously, you know, we have a construction loan on it, so you want to, you know, get rid of that construction loan, but then you also want to have income generating capacity, as you would have seen in multiple quarterly financial reports, where the income being generated by SRF, we have stated that we want to enhance that income. And this is one of the ways in which we can enhance the income from an asset that we conceptualized, we developed, we executed, and we put the tenants in there. So basically, there are no unknowns for us, right? It's basically our baby that we birthed. There's no better asset than that to hold on a balance sheet for income purposes, and then exit that asset at a much higher value when it suits us to do so. So that's how I would answer the question. I hope I addressed all the issues that were raised.
All right, thanks, Jason. All right, so the next question is in relation to, well, some of our major developments. So Mommy Bay and Lakes Bend are the next major development projects for the second life cycle. I know we're still in the development phase. How will we be targeting real estate investment nodes in the interim while these projects are being developed?
Right, so good observation or good question, right? So as I said before, that we are exiting real estate investment notes and therefore we'll be redeploying capital into real estate investment notes quite naturally. And so it's a dual process where while we are working and executing on those two large assets, we'll be also, we're already screening real estate investment nodes that want to deploy capital into. And obviously, we can't exit all the REINs that we have and don't replace them with REINs because we need replacement for that income that we want to maintain that level of income, a certain level of income from real estate investment notes, which are kind of consistent versus the lumpy nature of what, say, Lakespen and Mammy Bay would be. And so, yes, naturally, we'll do that over the course of next 18 to 24 months, which is typically the timeline for deploying capital into a REIN.
Thanks, Jason. All right, so the next question is in relation to Lakespen. What is the latest update on this strategic asset?
So I'll take that. And I did speak to this particular asset at Lakespen somewhat. An industrial asset in a very good location, and we are literally about to go into the execution phase in terms of the development plans. Obviously, at this stage, we're not going to reveal exactly what the investment plans here, but what we are doing, we are in the midst of the, let's say, the soft cost phase of seeking to unlock value. So it's an industrial site in a good location, and the plans that we will have gone through our internal investment committees are aligned with our mandate of unlocking the maximum value we can for the 55 acres that we have here. So I won't go into more detail than that, but just assure investors and shareholders that the value we will be unlocking at Lakespen is certainly one that is aligned with their best interest.
Thanks, David. All right, so the next question is in relation to Ocean's Edge. David would have touched on this during his presentation. What is SRF's exposure to the real estate investment note, and have we received updates from the real estate board?
Sorry,
so you want to go ahead, David? Okay.
Let me speak first of all to the matter with the real estate board. So we have made very good progress, but as we agreed with the real estate board, we will not make any public statements on the matter. And as I said during the briefing, that it's already in the public domain, but in our very productive meetings with the real estate board, we agreed that there will be no more public statements, and certainly all of the respective stakeholders and their attorneys are aware of the progress that had been made in respect of our Ocean's Edge.
What was the first part of the question again?
What is SRF's exposure to the investment note or to Ocean's Edge?
Oh, I think it would be about, I don't have a number at the top of my head, but it's somewhere in the ballpark of 700 million, Mash, I think. But I can get the number and provide it. I don't have it in my head.
All right, thanks, Jason. All right, so we have some more questions. All right, so this one is in relation to dividends and dividend considerations. So I want to point out that, well, the positive side is that the person is extremely pleased with the book value and the fact that it is going up. So I will say that first, since it was a part of the question. And then they're now asking in relation to dividends, they're of the opinion that we've now provided a pessimistic response. So I think Jason will take this one, which is different from the last two briefings that we had in relation to our results, where the discussions were more optimistic around dividends. So some feedback on where we are with respect to the dividend consideration.
So good observation. I would have touched on this very briefly, but let me just provide additional clarity given the question. Obviously, earlier during the year, we would have said, we may consider a dividend given in 2023, given where we expected to be with regards to exits. We have our timeline for exiting hasn't exactly hit as we would have anticipated. So we are a little bit behind in terms of, for example, completion of One Belmont, etc. We are still very happy with the project, etc. So that is what has given us cause for pause in terms of should we do this now or should we wait in 2024 when in terms of excess cash flow that we don't need to allocate to redeploy into either new assets that we have identified that we think are good opportunities to deploy capital into, to take advantage of the current environment and what we think the environment will likely be in, say, 2 or 3 years' time, as I would have explained regarding where Jamaica is heading and where rates are likely heading over that time period. So at the moment, we are still considering that, giving it serious thought, and hopefully I will have a more fulsome answer by the next earnings call, or it may very well be that it's before the next earnings call. But to answer the question directly, though, everyone sees the type of environment that we are in, and we are just being abundantly cautious in terms of do we start, because we don't want to start and then stop, right? We want to start and it becomes a continuous distribution from where we are. So based on the different moving parts, how high rates are, we're not sure where rates may turn next, but that's a factor. But the main factor is in terms of the timing of our exits, which would produce a large cash flow. Obviously, earlier in the year, we would have said that we wanted to exit Belmont a bit earlier. That timeline has been pushed back, and therefore, naturally, we are being prudent in terms of just saying, hey, let's consider not pushing too hard to make the first dividend payment now. Let that be perhaps in a couple periods from now. So I understand the question, and I hope that the person who asked the question and shareholders in general are too displeased with the answer that I'm giving. But yeah, that's really it. We have a fantastic asset that we will be exiting, generate lots of flows, and we want to start the dividend payments and continue paying it on a consistent basis. And we just feel that out of an abundance of caution, we should give that further consideration. Yeah, that's the best way I can answer it. If you need further clarification, please pose it a different way. I hope I've answered.
Thanks. Thank you, Jason. All right, so the next question, we're getting close to 11. The next question is in relation to interest rates and NFD. Have the higher interest rates dragged the sales of Surreal at the sugar mill properties? And this is in relation to one of the third-party projects that we've provided financing for, one that we classify as a REIT.
Want to take that, David?
Yes, I'll take it. From our discussions with the realtors who are handling the sale, there has been no real slowing down. That may be due to other factors such as the level of inventory or the level of other inventory available in the Montego Bay area. Certainly the list of persons interested and their capacity to obtain financing, we have not seen a dampening there. So clearly, whereas consumers are faced with higher mortgage rates, we are not seeing that translate into what the realtor is experiencing with the purchasers and potential purchasers for this particular product here, but I suspect it is a combination of factors, not just interest rate. It's availability of inventory in the area, and of course the desire of persons of what way they want to live, the type of investment that they're making. So the factors that affect the rate of sales is outside of just interest rates alone.
All right, thanks, David. So we actually went through all the questions. We have a follow-up question in relation to One Belmont and comments that were made earlier. In reference to the institutional investors that are going to be involved in the One Belmont project or asset, how are they involved? Is this occupation or ownership, and what is the extent of IL?
So, good observation, and I guess quasi question. So, institutional investors, when we say institutional investors, we are speaking about them buying or participating, you investing equity in the asset, right? So, One Belmont is gonna be a combination of internal exit, a combination of institutional investors, and as I hinted at, also for the possibility of based on the final design of our structure and the possibility for anyone to actually participate. So yes, institutional investors are participating. I would more than hope in the actual meaning they own or they are participating in the equity of One Belmont. And on the other side of the question, we're speaking about occupation. So these are corporates. So I wouldn't call them institutional investors. They are corporates. So the persons who are occupying the building aren't necessarily investors per se. They are just well-established and high reputation blue chip, quote unquote, corporations who want to put their headquarters in the building. And that's the purpose and the design of the building. And that is what has been executed, that, only what I would call corporations of a very high quality that are going to occupy the building. Of course, there is also the roof of the building, right? Whereby when we designed the plan, we didn't contemplate doing anything there. But as we have gone through time, we recognize that there's an opportunity to monetize the roof of the building, and obviously those occupants are likely occupants of the roof, if that actually is actualized, would be persons who are providing service. So I don't want to say much more than that. One Belmont is a dream. I don't think that when we started SRF that would have executed this type of project. So big kudos to David and team who conceptualized and executed this. And I'm sure that when it's finished, we are all invited to come and take a look at it, because what you're seeing from the road is very different from when you're in it. So I hope I've answered the question. If I haven't, just ask a follow-up so I can clarify. I don't want to leave any questions unanswered.
All right, thank you so much, Jason. So at this time, we're at 11. We managed to get through all the questions that were submitted. And I would like to thank everyone who participated in today's earnings call, and for your interest in Sygnus Real Estate Finance Limited. We do appreciate all the questions, all the feedback. We hope that we've provided the useful insights into the performance as well as the business's operations for you. At this time, we're going to encourage you to reach out to the team. If it is that you have any additional questions, you can send us an email, srf@sygnusgroup.com. if it is that you weren't able to ask your question today, or as Jason said, you have a follow-up question, we will respond to the emails. Additionally, you can find the recording of the earnings call in the investor relations section of our website, as well as on YouTube. And you can also find the audited financial statements and the management discussion and analyses published on our website, as well as the Jamaica Stock Exchange. So thank you again for joining us today, and we look forward to speaking to you at the next earnings call. Have a great day, everyone.